Hello everyone, I'm Wang Xirue, and I will kick off our presentation by outlining the scope and the purpose of our investment evaluation. Our report provides a critical analysis of Padini Holdings Berhad, a cornerstone of the Malaysian fashion retail industry. Over the critical 4 years period from 2021 to 2024, to ground our analysis, we benchmarked the Padini's performance against the industry giant MR D.I.Y Group Berhad. The period from 2021 to 2024 presents a journey from pandemic disruption to economic recovery. During this time, Padini's demonstrated remarkable resilience, growing its revenue from 1.22 billion to 1.64 billion, while RMDIY starting from a large base, expanding from 3.38 billion to 4.38 billion. The trajectory of Padini's recovery and its quality of earning are what's truly compelling. Our methodology involved a deep diving into 15 key financial ratios across 5 performance categories: profitability, liquidity, efficiency, solvency, and shareholder value. Through this ratio analysis and subsequent trend comparison, we aim to determine whether Padini represents a sound investment opportunity for our firm, says the financial analyst Berhad. In a nutshell, our findings reveal a company that has not only recovered but has strategically strengthened its financial position, emerging as a linear, more profitable and financially secure entity. Now let's dive into the specifics of its financial health.
Hello everyone, my name is Wang Shuyi and my student ID is 0368027, and I will focus on Padini's profitability liquidity, 2 pillars of its financial strengths. So first, let's look at the profitability. Padini's gross profit margin saw a steady and significant climb from 44.92% in 2021 to 50.30% in 2024. This indicates superior pricing power and effective cost control in its core operations. The net profit margin also showed consistent growth, rising from 6.56% to 8.54%. This steady increase signals effective containment of operational expenses on a solid rebound from the pandemic impact. And furthermore, the return on equity improved from 9.41% to 13.59%, demonstrating that Padini is generating more value from every ringgit of shareholders' investment. And then shifting to the liquidity. Padini's current ratio strengthened consistently from a solid 2.00 to a robust 2.24. And similarly, the quick ratio, which excludes less liquid inventory, showed a healthy upward trend, rising from 1.10 to 1.29. These figures paint a picture of a company with a strong and improving ability to meet its short-term obligations. It holds significant liquid assets, providing a reliable buffer against any unfolding market shocks. But however, a note of caution is, while very solid, the liquidity level is less extreme than previously thought, suggesting a balanced approach between safety and efficiency. And compared to Mr. D.I.Y, which maintains a similar current ratio around 2.0 but much lower quick ratio, Padini's strategy still appears more conservation, making safer bets in volatile times.
I'm Speaker Sun Yiting, and my student ID is 0368699. And I will now unpack Padini's operational efficiency and long-term solvency. Starting with efficiency, the data shows clear improvements. The inventory holding period decreased from 152 days to 143 days. For fashion retail exposed to seasonal trends, this is a crucial achievement, reflecting better inventory management and the reduced risk of obsolescence. Additionally, Padini maintained an exceptionally short trade receivable collection period, around 15 days, accelerating its cash conversion cycle and ensuring strong cash flow. On the solvency front, the trends are stable and reassuring. Padini's leverage ratio saw a slight increase, and its debt to equity ratio also rose modestly from 0.29 to 0.37. It's important to note that despite this increase, the ratio remains at a very low level. This indicates that Padini continues to be predominantly self-funded, relying on interval funds and retained earnings. In stark contrast, MR D.I.Y debt to equity ratio is higher, ranging from 0.41 to 0.46, as it uses more debt to finance new store openings. This conservative financial policy is further underscored by Padini's interest coverage ratio, which remained exceptionally high, between 17 and nearly 22 times. This means Padini's earnings are many times its interest expense, indicating an exceptionally strong capacity to service its debt. In summary, Padini is operating more efficiently and maintains a fortress balance sheet, underpinning its low-risk profile.
I'm speaker Tang Yingke and my student ID is 0376413, and my segment focus on what matters most to investors, shared value, and how Padini stack up against MR D.I.Y in key terms. For shareholders, Padini's performance has been outstanding. Earnings per share grew impressively by 15.5%, from 16 cents to 28 cents. Meanwhile, MR D.I.Y's EPS also grew healthy, from 5.6 cents to 9.7 cents. Padini's powerful earnings growth from a high basis is completed by healthy dividend yield, which stands high at 3.52% and saw slight moderation as share price appreciated, still signaling management's commitment to return value. Interestingly, Padini's price-to-earnings ratio declined from 15.63 to 13.57 over this period as its earnings grew. This suggests the stock may undervalued relative to its own history, presents a potential buy opportunity. MR D.I.Y in constant trade significantly high PE ratio, reflecting market expectation for future growth. Now, let's synthesize the comparative trend from 2021 to 2024. Padini shows strong and consistent growth in net profit margin, robust the improving liquidity and still very low debate level. MR D.I.Y will maintain high gross margin and improve its inventory turn, show more volatility in net margin and operates with high leverage. The key takeaway is that Padini offers a powerful combination of steady earning growth, financial safety, and attractive value, making it particularly appealing for risk-aware investors, while MR D.I.Y is a high-risk, high-growth potential story.
Hello everyone, my name is Wang Si and my student ID is 0376888. To wrap up, I will now share our final conclusion and investment recommendation. To summarize, we looked closely at Padini's performance from 2021 to 2024. Our analysis shows that the company handled the post-pandemic challenges very well. They have come out stronger with higher profits, better cash flow, more efficient operations, and excellent returns for shareholders. When we compare it to MR D.I.Y, Padini has a more balanced and safe growth model, where MR D.I.Y uses a lot of debit to expand. Padini's focus on organic growth and controlling costs. We believe this offers a better return with lower risk. Because of these strong positive trends, we confidently recommend that Success Financial Analysts Berhad invest in Padini Holdings Berhad. We're giving a buy recommendation for these key reasons. So the first is stronger profits. Both gross and net margins are going up, showing they are making more money. Second, financial safety. They have healthy cash flow and very low debt, which protects them during bad times. Third, better efficiency. They have improved how they manage inventory, which boosts their cash flow. Then, great returns. Earnings per share grew by 75% and they offer good dividends. Finally, is a good value. The PE ratio is dropping, which suggests the stock might be undervalued right now. In short, Padini is a perfect choice for investors who want steady growth and financial safety without taking too much risk. That's all. Thank you for listening. We are now happy to answer any questions you may have. Thank you.